Hello and welcome to our second lesson in our mini series. And in this lesson, we will talk about candlesticks and their formation. We'll talk about impulses and corrections, and we'll briefly talk about the three various market patterns. Okay, there are three various types of markets. Okay, let's begin with candlesticks. Um, I'll give you a little bit of history. The charts did not always used to look like this. I think in times before, the charts would look like this, like a regular graph marking out figures from time to time. And around the 18th century, a Japanese man created what we know today as a candlestick, and then he did this to um, get context, to create context on the performance of his business. Okay, so the candlesticks, what they do is they give you context, they tell a story. As you can see, the candlesticks have two colors on my chart. Um, the fact that it has two colors tells a story, it's giving context to um, the asset. So what is a candlestick? I define a candlestick as a visual tool that displays an asset's price movement over a specific time frame. Okay, a visual tool that lets you understand the character of an asset's price action. Okay, um, to explain this more, I'll just say baby pips. I spoke about baby pips and I said they have an extensive body of knowledge. And so, if you'd like to learn some more, you can visit baby pips and help yourself. Okay. Um, let's consider the candles on our screens. Okay. You can see the candle on the left is white and the candle on the right is black. The candle on the left is what appears to be green on most charts, and the candle on the right, which is black, is what appears to be red. In my case, they are gray and orange respectively. Okay, you can make it however you are comfortable. To understand candlesticks, you really have to understand the formation of a candlestick. Okay, and this is what a candlestick looks like. A candlestick has two main parts. It has a body, and then it has a wick, also known as a shadow. All right, and then a candlestick has four main components. To understand the context of the story the candlestick is going to tell you, you have to take note of the open, the low, the high, and the close. Okay, and how this works is, um, let's say we are trying to understand the price movement of a specific asset over the period of 5 minutes. Okay, and so this is the candlestick that is going to form in the period of 5 minutes. At the beginning of 5 minutes, the candle starts at the figure, at this figure. Okay, where it's labeled open. The candle starts at the figure over here, and then in the period of that 5 minutes, it visited this low point. Like the price came this low, and while it was at it, it also came to this high point. But at the end of the 5 minutes, when the candlestick should be formed completely, the price was at this figure. Okay, and that explains the body. The open and the close of the body, and then the regions where price visited are what we call the wicks. Okay, and as you can see, this candlestick is white. And the reason is white is because this is a bullish candlestick. Okay, a bullish market or a bullish candlestick is when price ascends. Okay, a bullish market is a market where price keeps going higher, and then a bearish market is a market where price keeps descending. Okay, when price keeps getting lower. And with the formation of this candlestick, you would observe that the candlestick opened at a figure down here and it closed at a higher figure. Okay, and that is the reason this is green, white, or gray. Okay, because it's a bullish candlestick. Let's apply the same knowledge to our bearish candlestick over here. The bearish candlestick opened within a period of 5 minutes. It opened at this figure right here, and while it was forming, it visited this region, and then it also came as low as this point. But at the end of the 5 minutes period, it was at this figure, and so it closed over here. Hence, the body and the wick. Okay, so these four components give you context to the behavior of an asset's price movement. Okay, um, I hope that is clear. Um, Once again, if you'd like to learn more, do visit Baby Cave. They have a lot of information available on their website. Okay. So we'll move on to the next thing. We talk about impulses and corrections. And if you notice, the markets, let's take this bullish movement for example. The markets came from this low point to a high point over here. However, it didn't do this in a straight line. It moved from a low point to a high point, another low point, a high point, a lower point, and stuff like that. And basically, that is how the market moves. It never actually moves in a straight line. And it is from this we have impulses and corrections. Okay, just like to breathe in and to breathe out. I'll talk about impulses and corrections a little more. We use this chart as an example. This is a bullish market, and we say it's a bullish market because the price um, the price commenced at a lower region and then is currently at a higher point. Okay, and this is a bearish market because the price started at a lower point and is currently at a higher point. Sorry, and then is currently at a lower point. Okay, and so we talk about impulses and corrections. Okay, let's use this bullish market as an example. Um, what is an impulse? An impulse is a strong movement in the direction of the main trend. Okay, a strong movement in the direction of a main trend. So with this market, for example, you can see it is a bullish market because we are going to the upside, and we define an impulse as a strong movement in the direction of the main trend. And so, by that definition, this movement right here is what we'll call an impulse. This one right here, because um, it's a strong movement in the direction of the main trend. Then we speak of corrections next. A correction is a short-term counter-trend movement where the price retraces or it pauses um, before the continuation of the main trend. Okay, a short-term counter-trend movement. Okay, and it's as if to say the price makes an impulsive move and then it takes a breather. It just pauses for a little while to collect itself and then it makes another move and then it will just take a breather and do that again. So these impulsive moves over here, these are impulses, the strong moves to the upside because they are going in the trend, in the direction of the general trend. And these over here are what we call corrections. Corrections can also be known as pullbacks or retracements. Okay, so I will use those terms interchangeably, and I hope you understand what I mean. This right here is a pullback, and then this here is an impulsive move. Another one right here because, as you can see, is in the direction of the main trend, and this is a counter trend movement over here. And so this is a pullback or a correction. Okay, let's look at it on a bearish market as well. A bearish market, we can see that price is going from a high point to a lower point. And so this movement right here that sends price in the direction of the market is what we call an impulse. And this movement right here that causes a breather or causes a counter trend movement, allows for a pullback or a retracement is what we call a correction, and so on and so forth. An impulse and a correction, an impulse and a correction. Okay, so I hope I hope it's clear and really simple. All right, and now we'll move on to talk about the three various markets. Okay, at every point in time, it's important to state that at every point in time, the market is moving in one of three directions. Okay, at every point in time, and these directions are upwards, downwards, or ranging. Okay, and remember we said the market that is moving upwards is a bullish market, and the market that is moving downwards is a bearish market. And also there's a third market, a ranging market or a consolidating market. Okay, we say a market is consolidating when the market is not making any specific movement and is just bouncing within a certain range, hence the term ranging. Okay, so we say a market is ranging when it's not making a specific movement in any direction and it just keeps bouncing around um, certain figures or a certain range. Okay, and this is a consolidating market. This is a bullish market going upwards. This is a bearish market. And once again, at every point in time, the stock market or the forex market is moving in one of these three patterns. Okay, this is what exists in the forex market, and so it is important to understand how they function and what they are. We'll talk more about these in the next episode.